Hi everyone, good morning. Today we're going to talk about a very important step of the accounting cycle, the adjusting process or adjusting journal entries. This is actually the fifth step of the 9-step accounting cycle. I'm going to show you the steps now. We know that we have the 9 steps starting with transactions analysis. Step number 1, which you do using the accounting equation. Then journal entries or recording transactions using journals, classifying transactions using ledger, summarizing transactions using the trial balance. So if there is no mistakes, no adjustments necessary, then step number 4 is an ultimate step. We already have the trial balance and the trial balance doesn't need any adjustments. But what happens in reality, that trial balance items or the account balances of the trial balance need adjustments. Many of them need revisions, many of them need changes, increases or decreases, or many of them are newly inserted. Items that doesn't appear or didn't appear in the trial balance need to be inserted or need to be incorporated into the trial balance. So that makes the adjustment process an essential step of the accounting cycle. So that means we now have steps 4, 5, and 6 all involving the trial balance. Step number 4 is the unadjusted trial balance. You can see here. Step number 4 is the unadjusted trial balance. Then you have the 5th one, adjusting journal entries or the adjustment process. And that leads us to an adjusted trial balance, which gives us the perfect launching pad to prepare financial statements, which is the ultimate deliverable of the accounting information system. Once you have the financial statements, then we have 2 steps, which are primarily mostly optional: closing entries and post-closing trial balance. Especially step number 9 is an optional step. So what is important for us to understand is not the numbers, not the 9 or 8 steps of the accounting cycle, is that we need to have an appropriate, a complete, a reliable, a useful trial balance, which is complete and, as I said, revised, which doesn't need any obvious revisions or any adjustments, which you can use to prepare our financial statements. Because preparation of financial statements is the ultimate step, is the ultimate function of accounting. Because for external reporting, we need to furnish our investors and creditors and all other users, especially external users, with the essential relevant information about our company, about our organization. So financial statements are the ultimate outcome of the accounting information system. And transactions, as I showed before, the transactions are the input of the accounting information system, and financial statements are the output of the accounting information system. But to prepare financial statements, to prepare those statements like income statement, the equity statement, the balance sheet, and cash flow statement, to prepare these statements, we need a reliable, we need a complete trial balance, we need account balances that can be placed into the financial statements. So those account balances are found on a piece of paper called the trial balance. And if the trial balance is not reliable, if that is not useful, if that is not complete, especially if that is not complete, then that is not going to lead us to preparation of useful financial statements. Anyway, so what is the adjustment process? To start with, an adjustment process actually involves primarily 2 types of adjustments. One is called deferrals, another is called accruals. It means there are many expenses that we did not record, or we either missed or didn't occur while doing the regular accounting or routine accounting. For example, at the end of the period, there could be wages or salaries or rent or interest, many expenses that are not necessarily payable on the last day of the financial accounting period. For example, most companies pay their wages on a weekly basis or a bi-weekly basis, fortnightly basis. So there is no guarantee that your week will end on a Friday, or your Friday will be the 30th of June or 31st of December, or whenever your financial accounting period ends. So financial accounting period ends usually on June or March or September or December, but Fridays or fortnightly payments could be processed on Tuesdays or on weekends. So what happens is that we are finishing our financial statements, preparing financial statements on the 31st of December, but the wages for the last 3 or 4 days of the last 3 or 4 weeks may not be payable until the first week or second week of January. And In addition to this, there could be occasions when we do not have the financial ability, or when even if we have the financial ability, we may not have completed all the transactions. We may not have paid all our dues. We may not have paid all our bills. We may not have even received the bills. So it is very often possible that you receive a telephone bill of December at the beginning of January. So how do you pay the December bills? So December utility bills, December power bills, for example, water bills or energy bills could be paid in January, or are usually paid in January. So the December expenses must now be recognized before payment. So that needs an adjustment. There could be occasions when we made advance payments. We have prepayments, which are deferrals. Prepayments like prepaid insurance, prepaid rent, or prepaid subscriptions. So those prepayments are usually made during the financial period, like in March or June or September, that lasts for, say, 1 year, 12 months or 6 months. So on these occasions, you would have a December 31st cutoff period, but your subscriptions are not necessarily paid at or on the end of the year, or at the cutoff period of the financial statements. So, for example, you have made advance payments of your rent for, say, 3 months starting in November. So that lasts for November, December, and January. So at the time you made the payment, you recorded it as an asset, because it was an asset. The whole amount was prepaid. So you debited prepaid rent and you credited cash. Now your prepaid rent was sitting there as prepaid, but when you have the end of the period, you now have to recognize that 2/3 of those prepaid rents are now expired. They are now no longer prepaid. They already expired. They are like rent expense. Only 1 month, one of the 3 months is still prepaid. It is likewise, it could happen for subscriptions, advance payment of subscriptions, advance payment of special insurance, and many other membership fees, many kinds of expenses that we have to make in advance. We have to pay in advance. So when we make the payments in advance, we record it as an asset. That means it is not going to be an asset for the rest of its life. At some point, assets are expenses. Like one great economist, Keynes, said that in the long run, we are all dead. Like in the long run, there is no asset. Every asset is an expense. In the long run, there is no asset. There is no long run cost or long run asset. In the long run, everything is an expense. Anyway, so that is beside the point. So what I wanted to emphasize here is that it is necessary. There are needs to make adjustments to accounting numbers, because accounting numbers are dynamic numbers. They are true at the time of recording it, but then as time elapses, as time goes by, they need adjustments, because assets, as I said, assets become expenses as we go, and new expenses occur, new expenses are incurred, accrued, which needs recognition. So to complete all these activities, we need to make adjustments, and we need to have adjusting journal entries. So I'm going to show you 4 major categories of adjustments. The first one is an expense discovered to be unpaid. So this covers a whole group of activities where, take a look at this, an expense discovered to be unpaid. It means the expense has occurred, the expense has been incurred, but we have not paid it. So we have just discovered that we have an unpaid bill, we have unpaid utilities, unpaid rent, unpaid wages, unpaid salaries. So how do we make the adjustment? We said we recognize the expense by debiting the relevant expense. So whatever that expense is, rent or utilities or wages or salaries, recognize the expense is your first step. So you have to debit the relevant expense and recognize a liability because it's unpaid. Had you paid it, it wouldn't be occurring as an adjustment, wouldn't be occurring at this point in time. But the fact that you haven't paid it, it has to be recognized as a liability. So this is how you adjust it. You recognize an expense and recognize a liability. So this is the journal, or these are the journals. I gave 3 examples. One is if we just discovered that our rent expense has not been paid, so we debit rent expense, credit rent payable. If it's insurance, we say insurance expense debit. If it's interest, unpaid interest, so we debit interest expense and credit interest payable. For utilities, we have a similar example, debit utilities expense and credit utilities payable. So this accounts for not just these three, any expense whatsoever that you just discovered that it is unpaid, it has not been paid, then debit that particular expense. So if it's rent, we debit rent expense. If it's wages, we debit wages expense. If it's salaries, utilities, interest, any expense, you debit that expense. It means you are recognizing it as an expense for that period. And the fact that you haven't paid it doesn't matter. You're going to pay it in the future. So anything that is payable in the future is a liability. Anything for which you have received the utility, you have consumed the services, but you haven't paid for it, that means it's a liability. We owe a party, we owe our suppliers. So that's a liability. So it would be interest payable, wages payable, rent payable, salaries payable. Whatever is unpaid would have to be recognized as a liability. At this point, I'd like to draw your attention to one of the accounting principles called matching principle, because that is at the heart of the adjustment process. Matching principle. Matching principle means the accounting process should match revenues with expenses. So if I'm doing financial accounting for, say, the month of September or for the year 2020, then the revenues earned during this period, remember, the revenues, all the revenues you earned, you made during this period must be matched with the expenses for the same period. So if I have, say, revenues for September, say $10,000, but my expenses are not all matched, or the expenses are not recognized, not just because I'm reluctant to recognize it, but maybe they're not payable until October. So not payable until October doesn't mean that I have not expensed it. Doesn't mean that I have not received the utility of that expense, or doesn't mean that I have not used those expenses to earn the revenue. That's more important. Like, look at this. So here's a cup of tea or coffee. Let's say I sell this tea for $2. So that's my revenue. Now, to make the tea, I need to have spent on milk or sugar or cream or coffee or tea, hot water, other depreciation of the kitchen utilities, utensils or appliances. So all those expenses that contribute to the preparation of tea must be matched against the $2 revenue that I made. So as an investor, for example, you have an investment property. So you made $10,000 from rental income, but there are expenses. There are depreciation of the property, there are management fees, and many other expenses associated with the investment property. All those expenses must be matched against the $10,000 revenue that you made from investing in that property, from renting that property out. So a fair assessment, a fair preparation of an income statement or fair income number requires that the $10,000 revenue is matched against all the expenses that contributed to generating that revenue. So that's the matching principle, that our revenues must be matched against expenses. If expenses are not paid, that is okay, but if the expenses are not recognized, that is not okay. So non-recognition is not okay. Non-payment can be okay if you have an arrangement with the party. If my landlord or landlady agrees to receive a payment 7 days later, that is fine. That's not going to make me bankrupt. If my bank doesn't bill me until next month for expenses that I have incurred during this month, that's fine. If my utility company allows me 21 days to make the payment, that is okay. But if I don't recognize it, if I do not recognize the utility that I consumed, that I used during this month to generate the revenue that I made during the month, then that is not good accounting. That is not fair accounting. So accounting process requires, especially the income determination process, requires that the income is the outcome of all revenues for a period minus all expenses for a period, no matter whether we paid for the expense or not. And sometimes we pay later, sometimes we pay in advance, and even advance payment doesn't need to be recognized as an expense, because advance payment is an asset. But if advance payment or part of the advance payment is consumed during this period, then that portion must be recognized as an expense. So what is important is that identification of revenues for a period minus expenses for the same period. All right. So coming back to our category number 1 is an expense discovered to be unpaid. So if it happens, then that expense has to be debited and a liability has to be credited. So that's our journal, and this accounts for a whole group of adjusting journal entries. Then group number 2. This is an asset discovered to be expensed. An asset discovered to be expensed means something that we originally recognized as an asset, like prepaid rent, prepaid salaries, prepaid subscription fees, prepaid membership fees, prepaid gym membership, prepaid, even sometimes prepaid interest. So all those prepayments, especially for students, when you prepay for meals, then you have prepaid meal vouchers or prepaid dorm rent. So all those are prepaid tuition. So these are all assets at the time of payment. But are they going to be assets for the whole life? No, because if today I buy say 40 meal vouchers, and then as I keep using those vouchers, as I keep going to the dining hall, or as I keep eating out of those vouchers, then those vouchers are going to be expired. Those vouchers are going to be used. So that means they are becoming gradually, they are becoming expenses. So this is that category of adjustments. An asset discovered to be expensed, or an asset that turns out to be an expense by now. So it was originally an asset, but now it's not an asset anymore. So how do we do the adjustment? We recognize the expense because part of that asset or all of that asset has now been spent. So recognize the expense by debiting the relevant expense. So it could be meal expense, it could be insurance expense, it could be rent expense. And then recognize a reduction or the reduction in the asset. Because as an asset is expensed, as an asset is used up, then that asset goes down, keeps going down. So let's have an example of say prepaid rent. Most of us have prepaid rent or prepaid meal vouchers, prepaid insurance, for example, or even supplies like prepaid supplies. So we don't call prepaid supplies when we buy supplies, we debit supplies because supplies is treated as an asset. Now, when you buy supplies, you buy an asset, but are they going to be asset all for the rest of their lives? No. So let's say I have some say a bag of supplies here. Now, when I bought it, it's say $2 of supplies, so I debited supplies as an asset and credited cash. But as I keep using these tissues or napkins or serviettes or cotton buds, then they are going to be used up. So can you see my asset is now becoming an expense. So as they become expenses, I have to recognize those expenses. So I debit expense, debit supplies expense. So debit the expense, that's what we're asking here. If assets are recognized to be expensed, then debit the expense, relevant expense, and credit the relevant asset, because an asset is reducing, as I showed in my bag of supplies. As I use those supplies, then the volume of supplies, the level of supplies is gradually coming down. So when I originally bought it, it was say $2. Now I used say some of it, so 50 cents is expensed, and then another week, another 50 cents is expensed, another week, another 50 cents is expensed. So gradually all this, the whole asset will become an expense. As I said initially that in the long run, there is no asset. In the long run, everything is an expense. Like in the long run, there is no, in economics and microeconomics, we say, in the long run, there is no fixed cost. All costs are variable. In the long run, there is no fixed cost curve. There is only a variable cost curve. So in the long run, there is no asset. Nothing is an asset. In the long run, everything is an expense. Anyway, so these are the examples. If it happens with supplies, so you originally bought say $700 worth of supplies, and you recorded it as an asset. The supplies is such small items, it is not fair or not necessary and not even appropriate or not even efficient to recognize it as an expense every time you use a napkin. So what do? You keep using your toilet supplies, you keep using your say machine tools, you keep using your janitorial supplies, cleaning agents, and then at the end of every period, like on a periodic basis, you take a physical count and you see how much is left there. So when I bought it, I bought $700 worth of supplies, and so after a couple of months, I now have only $200 worth of supplies. So that means the remaining $500 worth of supplies are used up. They're missing. They're gone. So why are they gone? They have become an expense. So supplies would now become supplies expense. Okay, add the suffix expense. Supplies now becomes supplies expense. When you originally purchase it, you debit supplies, you record it as an asset, which is supplies, but now you're recognizing it as an expense, a part of it as an expense. So you debit supplies expense and credit the corresponding asset, means recognize the reduction or a reduction in the volume of that asset. So the journal entry is going to be like this: supplies expense, debit, supplies credit. Another one, insurance expense, debit, prepaid insurance, credit. So the insurance one is Like when you purchased insurance, you paid for say 9 months worth of insurance at a time, or you paid say 3 months worth of insurance at a time. So of course it was appropriately recorded as an asset because it was prepaid. So let's say my monthly renter's insurance is, which actually is $15. So let's say my monthly bill is $15 and I paid for 3 months at a time. So at the time of purchasing that insurance, I debited it all as prepaid insurance. And then as every month goes, $15 becomes an expense. So this is the insurance expense. So debit insurance expense, I'm now recognizing it. Remember, I'm not making a new payment. I already made a payment. I already made the payment at the time of purchasing the insurance. Now it's time to recognize. It's only a recognition issue now. So debit insurance expense and credit prepaid insurance. So your prepaid insurance goes down, like asset goes down, and the part of the asset that's gone down is an expense. And that is true, isn't it? Whenever asset decays, any decay in asset means it's an expense. Any reduction in the value of an asset is an expense. Whenever, like if there is tooth decay, if there's like hair going gray, so as the more hair goes gray, the more expensive it is. So when hair is all black and shiny, that's an asset. But as it goes gray, it's an expense. So it's true for every other asset, that when assets go down, then that's an expense. When assets go up, that's the revenue. That's like income. Anyway, and we have a third one, which was rent. The company recorded it, or the party, our accountant recorded it as prepaid rent at the time of paying the rent for say, several periods at a time. But as every period goes by, we debit the expense. The relevant expenses, rent expense. So we debit rent expense, credit prepaid rent. So you can see every time the prepaid part is going down. So asset is going down, asset going down is credit, asset going up was debit, and asset going down is credit, and expense recognized is debit. So here is the second category where you discover that an asset that was originally acquired as an asset has now become an expense. I'm sorry about the noise. It's a bit noisy, but I hope you can still hear me. Then the third category is a receipt that was originally considered a liability, now deemed to be a revenue. So read it carefully. A receipt of money that was originally considered a liability, like an unearned fees or unearned revenue, has now become an income, means it has now been earned. So let's say I offer accounting lectures. So before offering those lectures, people pay me money in advance. So when I receive some money in advance, I record it as unearned income, unearned, say, teaching revenue, or unearned lecture fees, unearned speaking fees, or speaking commission, speaking fees, all that. So when I received the money, I considered it appropriately as a liability. So I debited cash, I received the money, I debited cash, but I didn't credit it as an income because it was not income. The earning process wasn't complete. The earning process may not have even begun. So now that, say, I have delivered some of those lectures, I have performed part of the job, or maybe the whole job, then it's not a liability anymore. You see my point? You receive $10 to perform a particular duty, to say do someone's lawn mowing, or to teach someone accounting, or teach someone, say, piano, to offer piano lessons. So you receive the money, you debited cash, and you credited it as unearned income, unearned fees. Lawyers regularly do that, and auditors do that, plumbers do that. Sometimes they receive money in advance. So any money received in advance is a liability. That is okay. But this is not going to be liability for the rest of its life, especially if we perform the duties, if we offer the deliverables, if we offer the job, if we complete the job, or complete. As we keep completing the job, like subscription revenue, for example, journal publishers or magazine publishers, they receive money in advance, or newspaper publishers, they receive money in advance, which is a liability. But as they keep publishing, or as they keep delivering the news, then part of the earning process is complete. So they can start recognizing it as income. So this is what our third category is, that a receipt originally considered to be a liability, now deemed to be revenue. For example, An unearned income can be deemed to be earned if the earning process is substantially completed. If the earning process is substantially complete, that's the revenue recognition issue. So we can park it for the time being. So this is how you do it. You reduce the liability as you discover that, or as you find out that part of that unearned revenue has now been earned. So you reduce the liability, and we know that all liabilities are credits when they originate. So when you reduce it, it will be debit. So now have the debit part of the journal entry. So debit unearned fees, for example, or unearned revenue, and then recognize the revenue. Credit the revenue, credit the relevant revenue. So if it's plumbing revenue, if it's professional services fees, if it's legal services fees, or any fees income, then you credit earned revenue. So see, debit unearned revenue, credit earned revenue. Unearned revenue was a liability. Now we are debiting it, so we are reducing that liability because it's not a liability anymore. And then crediting the corresponding income, credit earned revenue. The second one is unearned fees, which was originally unearned, now it's earned. So you can see debit unearned fees, so that reduces our liability, but we are now crediting fees earned. So the fees, $10 of fees have now been earned. So take another look. There are 3 examples here. These are all originally recognized as liabilities, but now they are converted into income. Okay, the 4th category is here. Recognize end of period costs such as depreciation, amortization, impairment, write-off, etc. These are creeping expenses, I call dormant expenses. Creeping expenses means there are no definite party here. Like there are no party, like no customer, no supplier with whom we are having this transaction. So this is a transaction like that happens as a routine process. Like my laptop here, the one that I'm doing this recording, is depreciating every second or every week or every month. Now, if I am an aggressive accountant, if I don't care about depreciation of assets, then I can under depreciate or not depreciating means I'll be understating my expenses. I'll be overstating my asset because my accounting books will keep recognizing the laptop as a brand new laptop forever. But it's not brand new forever. It was brand new. Say when I bought it for $900. So I debited equipment for $900 and credited cash or accounts payable, depending on how I paid. And then the $900 is going to be depreciated on a gradual basis. Let's say the laptop had originally considered to have had a life of 3 years. So $300 would have to be depreciated every year. So this is a dormant or creeping expense, creeping transaction. That means it happens at its own pace without anyone vividly noticing, like building depreciation, furniture depreciation, so depreciation, amortization, impairment, and write-offs, like bad debts written off or allowance for bad and doubtful debts. We have hundreds of millions of dollars of accounts receivable, and some of it had to be or has to be recognized as not collectible, as doubtful. So that is a recognition issue. Responsible accounting means we have to constantly keep an eye on those receivables. Like we have to keep an eye on all our assets and see how our assets are decaying, or whether, if, of course, I don't think it's an if issue. I'm sure it's a how much issue or when. So it's not a matter of if, it's a matter of when and how much. How much of those assets are actually being expensed or are being decaying, being used up. Anyway, so this is that category. Recognize end of period costs such as depreciation, amortization, impairment, write-offs, etc. So how do you do it? First, you recognize the expense by debiting, say depreciation expense. We are recognizing the expense and credit the associated contra asset. Create the contra asset or recognize the contra asset, which is accumulated depreciation. Remember, depreciation expense is an expense, and accumulated depreciation is not a liability. It's a contra asset because it is contrasted against the asset on which it's been accumulating or on which it has accumulated. So if I have buildings of say $100 million and accumulated depreciation is $70 million, then my book value of the building is going to be $30 million, because book value is the original cost minus accumulated depreciation. So furniture, say I purchased $7,000 of the furniture, and of which $3,000 has so far been depreciated. So that means I have $4,000 of remaining book value left. So this is how we recognize these dormant transactions or dormant expenses: debit depreciation expense on equipment, credit accumulated depreciation on equipment. So for every asset that you are asked to depreciate, you just follow the same template: debit depreciation expense from a particular asset. Could be equipment, could be building, could be furniture, could be other appliances, and credit accumulated depreciation. And the same applies to bad and doubtful debts. If we assess that $30,000 worth of our accounts receivable has now become doubtful, then we have to recognize it all as an expense. So we say debit bad debt expense, credit allowance for doubtful accounts, ADA. You can say this one is for write-offs, bad debts written off. Well, creating a provision for bad and doubtful debts. So the bad debt expense is $15 here, which has been assessed. It's an assessment, it's an estimate. We don't know exactly how much is going to be bad or how much is going to be written off. So based on our best assessment, best information, we thought against all the revenues that we made during this period, $15 has to be written off as an expense, as uncollectible. So bad debt expense is recognized as an expense, and associated contra asset, which is ADA, allowance for doubtful accounts, has been credited. This ADA is then adjusted against accounts receivable. On the balance sheet, we present accounts receivable as accounts receivable net of any allowance for doubtful accounts. So these are our 4 different types of adjustments that I could assimilate. I'm showing it all again. Number 1, expense that has just been recognized to be unpaid, just been discovered to be unpaid. So unpaid expenses or accrued expenses that have not been paid. Debit expense, credit, payable. So rent expense, credit, rent payable. Second one, an asset discovered to be expensed, like supplies. So debit supplies expense, credit supplies. Debit insurance expense, credit prepaid insurance. Debit rent expense, credit prepaid rent. Third one, a receipt originally considered to be a liability, now considered to be an income. So debit the liability, reduce the liability, debit unearned fees or unearned income, credit earned income. And finally, fourth one is for depreciation, amortization, impairment, write-offs. So debit the expense, debit the expense, depreciation expense or whatever expense it is, amortization expense. If it's on, say, on a franchise, if it's on an intangible, then we don't call it depreciation expense. We call it amortization expense and the accumulated amortization. So, for example, you had some franchise cost that is gradually being amortized. So, debit amortization expense or franchise expense, credit accumulated amortization. And the same is true for depletion. Although for introduction to accounting, we don't need to go that far, but for natural assets like natural resources, say coal mines or forest assets, we don't depreciate or amortize, we deplete. So debit the corresponding expense and credit accumulated depletion. Anyway, so this is that 4th category. So now take a deep breath, take a few seconds, and then we're gonna do some practical journal entries based on an unadjusted trial balance, and then I'll show you how we convert that unadjusted trial balance into an adjusted one. Okay? So you can pause and take a rest. I'm back now. All right, so here I have, this is an unadjusted trial balance. It's an incomplete trial balance. The total of the debits and credits are not going to be the same, but it has some items that need adjustment. The first 3 do not need any adjustment: cash, accounts receivable, and inventory. They're all good, but from supplies down, they need, many of them need adjustments. So this is our unadjusted trial balance. If none of them need any adjustment, then it's adjusted trial balance. Then it's an adjusted trial balance. then we don't need to go through or carry out the adjusting process. Okay, but as it turns out that some of these items need adjustment. So let's start with supplies. You can see supplies here is how much? $300, isn't it? $300. And then we are told here the supplies actually on hand. You can see supplies we thought we have supplies of, look at it, we have supplies of $300. This item we thought we had supplies of $300, and then turns out that we don't have $300 worth of supplies. How much do we have? We have only $120 worth of supplies. So that means there is now a discrepancy. My old documents say $300. My new documents say only $120. So the $180 worth of supplies are missing. Now they are not stolen. Hopefully, they have been used. So anything that's used must be recognized. You know, if you use it, you have to recognize it. Like that, all the single ladies line. Remember, if you like it, you have to put a ring on it. Remember Beyonce's all the single ladies. If you like it, you have to put a ring on it. So if you have spent it, you have to recognize it. So what you see here is that the $300, the original information, minus the current or more up-to-date, more relevant information, tells us that we have only $120 worth of supplies. So that means $180 worth of supplies have been consumed or expensed. So we have to recognize it as an expense. So debit supplies expense, credit supplies. This is your journal entry to recognize the part of supplies that have been expensed, that have been used up. Okay. Second one is prepaid insurance. You can see an item here was in the unadjusted trial balance was prepaid insurance of $600. $600. Now we are told this, that the prepaid insurance of $600 was for 12 months. Was for how long? Was for 12 months, ending in December 2020. So 12 months ending in December 2020. And what time is it now? Today is the 30th of September. So that means you have just ended 9 of the 12 months. So if $600 was paid for 12 months, how much was paid for 9 months? As it turns out that the monthly insurance expense is $50. You can see 600 divided by 12 gives you 50, and 50 times 9 gives you $450. So $450 of the 600 have been expired, have already been expired. So that's what is the maths. You can see 600 by 12 is 50, 50 times 9 is 450. So now 600 minus 450 is 150. So only 150 is going to be prepaid. The remaining 450 is all used up. So the entry is going to be for the part that's been used up. So we debit insurance expense, credit prepaid insurance. So that is our second adjusting journal entry. So our numbers are gonna change. Our prepaid insurance in the adjusted trial balance. Keep in mind that the prepaid insurance, you're not going to see $600. You're going to see only $150. The remaining $450 is going to be insurance expense. All right. So those are two of several adjustments that you have to do. The third one is about prepaid rent. You can see we had an item called prepaid rent of $900 in the unadjusted trial balance. So this red one is our unadjusted trial balance. Okay. So how much is our prepaid rent here? How much was prepaid rent? Prepaid rent was $900. Of the $900, let's now listen to the story. Let's hear the story. We're told that the prepaid rent was for 6 months. Prepaid rent was for how long? Was to cover 6 months ending in January 2021. So 6 months ending in January of next year. That means it was supposed to cover, and we are given more explanation. It says it covers the period from 1st of August to 31st of January of next year. So 1st of August until end of January of next year. So August, September, October, November, December, and January. So that makes it 6 months. So now see, of the 6 months, how many months have been expired? Only August and September have. So 2 months of rent must be expensed, must be recognized as rent expense. It's not prepaid anymore. Can you see the point? When you made the payment, all $900 was prepaid. So you rightly recognized it as an asset. You appropriately recognize the whole lot as an asset, as prepaid rent. But now as months go, as you go by, and if you prepare financial statements at the end of September, then 2 months worth of prepaid rent must be slashed, must be knocked off. So that's what we did here. You can see I made boxes for each of those 6 months. Of the 6 months, 2 are crossed out, means 2 are gone. So how much is for every month? So $900 for 6 months, $150 for a month. So $150 for this month, August, and another $150 for September. So $300 must be expensed, and that's what we did here. Debit rent expense. You can see rent expired, $300. Debit rent expense $300, and credit prepaid rent. So we have recognized an expense and reduced the asset. That's the rule, that recognize the expense and reduce the corresponding asset. Recognize an expense and recognize a reduction in the asset. So our asset has gone down by $300, and that exactly $300 is our expense. Okay, so there's the rent expense line. Number 4, we are told, you can see we had a couple of assets here. We had buildings of $60,000 and accumulated depreciation on building was $20,000. We had equipment of $15,000 and accumulated depreciation on equipment of $9,000. So these 2 or 4 items corresponding to assets. One was building. The original cost was $60,000 and had some accumulated depreciation, which was $20,000. And equipment, original cost was $15,000, accumulated depreciation was $9,000. So let's see what happened. We're told that those 2 assets must be depreciated. By how much? Depreciation of building is $2,000. You say depreciate building by $2,000 and equipment by $1,100. So that's an estimated depreciation. So depreciate those assets means debit depreciation expense. So we are debiting depreciation expense on building $2,000, depreciation expense on equipment $1,100, and credit corresponding accumulated depreciations. These are contra assets. See, debiting expense, and we are not crediting assets, but we are essentially crediting assets, but we are going to do it via contra assets. You know, in old days we used to directly credit the asset, like debit depreciation on building and credit building itself. But using American accounting, US GAAP does it this way. We debit depreciation expense and we credit accumulated depreciation of the corresponding asset, so that we can, throughout the life of the asset, we can see, the users can see the original cost of the asset and how much has been depreciated so far. All right, so this is a standard depreciation entry for every depreciation, as I said before, depreciation expense of the particular asset and credit accumulated depreciation of relevant asset. So that's group number 4. The 5th one is easy unpaid wages. We had wages expense. Here you can see there's an item called wages expense of $7,000. Okay, so now if there's some more unpaid, then that means the wages expense that's reported here is not complete, is not accurate, is not correct. The correct amount is higher because some wages have not been paid. So how much? It's $1,000. Unpaid wages of $1,000. That means we have to recognize this unpaid part as an expense. So debit wages expense. See, whether you paid or not does not matter. What matters is that you have incurred it. You have incurred the expense. You have used those labor force. So you have to pay them. You know, and you have a liability on your shoulder, and you have to recognize it as an expense because you have used their services to generate the revenue that you did. So for proper matching, your revenues must match with your expenses, or your expenses must match with your revenues. And you also debit wages expense for that $1,000 that remains unpaid, and credit unpaid wages or wages payable. Then look at this unearned revenue item. Unearned revenue, we had an unearned revenue of $1,000. That also needs adjustment. The adjustment is this: 1/3 of unearned revenue, 1/3 of it has since been earned. Good news. So it's not all unearned anymore for the whole time. It was unearned when we received the money, but now 1/3 of it has been earned. So we have done some work. So that means that unearned revenue must be knocked off by 1/3. So a liability is credit when it originates, but now it's going to be reduced. So when to reduce the liability, we debit that liability. So debit unearned revenue for that 1/3, $333, and credit revenue earned, $333. So earned revenue will be newly inserted in the trial balance if there is no item for earned revenue. But more importantly, the unearned revenue must not be shown as $1,000. 1/3 of it has to be slashed off. All right, so these are the adjustments, and after doing those adjustments, you can see we have a brand new trial balance. So this was the original one, and this is the new one. So please compare the two. You can see the first three items, cash, accounts receivable, and inventory, they are the same. There are no changes between the unadjusted one and the adjusted one, because none of the adjustments affected those accounts: cash, accounts receivable, and inventory. Then from supplies down, all of them have changed. For example, in the unadjusted one, supplies was $300. And see how much supplies is here? Only 120, because we are told that only 120 is left over, is still there. So supplies, $300 replaced by $120. That means the $180 that was used or consumed or missing has to be entered as a new item called supplies expense, which didn't even exist here. Supplies expense wasn't here. There's no expense called supplies expense, but we have an expense called supplies expense here. So that's $180. The two together is still $300. Then look at the next item, prepaid insurance here. Prepaid insurance was $600, but we are told that prepaid insurance is not $600 anymore. Prepaid insurance is going to be only $150. Remember that $450 has already expired. So prepaid insurance has gone down from $600 to $450. Sorry, from $600 to $150, making the $450 of a new expense called insurance expense. And then we have an item called equipment here. We have prepaid rent. Can you see prepaid rent of $900? And that has changed here. Prepaid rent of $900 has become prepaid rent of only $600. See, the unadjusted one, it was $900, the prepaid rent of $900. But in the adjusted one, this is only, see here, the adjusted one, it's only $600. That means the remaining $300 is rent expense. So prepaid rent of $600 from $900, it has become $600. Means the $300 has to be expense, and that $300 has been added to rent expense, which was originally the original trial balance. We had $5,000 worth of rent expense. You can see here, $5,000 worth of rent expense. So with the $5,000, we have now $300 more. So that made it $5,300 of rent expense. If rent expense didn't exist, then we would insert a new row for rent expense and make it $300. But on this occasion, we already had an item called rent expense, which was $5,000. So with the $5,000, we have added $300 to $5,000 to make it $5,300. So rent expense has changed. Then we have building and equipment and their accumulated depreciations. Can you see? That's our building and its accumulated depreciation. So how much? So building is $60,000, and building here is also $60,000. You can see building is $60,000, but accumulated depreciation is not $20,000 anymore. It used to be 20,000. See here, accumulated depreciation on building used to be $20,000, but it is now $22,000 here. See, 22, and the same happened to equipment. Equipment was $15,000, and its accumulated depreciation was only 9,000 here. See, 9,000, and that has, so equipment was, I forgot to enter equipment here. So equipment is still sitting at 15, but its accumulated depreciation is now 9,000 plus 1,100 is how much? $10,100. So look at the two together here, equipment and accumulated depreciation on equipment. Equipment is okay at 15, but accumulated depreciation on equipment is the new amount of $10,100. That means the original 9,000 plus 1,100 of depreciation expense on equipment. All right, next is wages expense. Wages expense was how much? Was $7,000, and how much wages was unpaid? 1,000. Remember? So the original expense of 7,000 plus the new expense of 1,000 makes it 8,000. Can you see? Compare again, please. Wages expense here was $7,000 right here. 7,000 right near my finger, and here it is 8,000. It is $8,000. Unadjusted trial balance had is 7 plus the $1,000 unpaid, so that makes it $8,000 of wages expense, and the associated wages payable, the liability, recognizing or reporting that we have not paid it yet, is wages payable. So that's $1,000. And finally, the unearned revenue, original one, the unadjusted trial balance showed it as $1,000 of unearned revenue, $1,000, but we are told that a third of it has since been earned. So we have earned revenue, see revenue earned of $333, and that leaves us our unearned revenue at $667. So unearned revenue goes down and earned revenue emerges, is born as a new item. All right, so this is the adjusted trial balance. That is much better than this one, but this one was incomplete. This one also balanced, the complete, if I had the complete trial balance, it would balance. But balancing doesn't mean that it's correct. There are missing items. There are items that they forgot or that didn't occur until the end of the period, like depreciation, like especially the two depreciations or the unpaid wages, because until it becomes unpaid, you cannot recognize it as unpaid. So only maybe on the last day or the last week of the accounting period, it has become unpaid. And also, so the same is true for expired insurance, expired rent, and all those. As time goes by, there'll be more expired. Like by the end of the next month, October, there'll be more rent and insurance expired. Another $50 of insurance will be expired, will be an insurance expense, and another $150 of rent will be expired. So what is important is to understand that these items, like prepayments or assets, these are very transitory assets. Like William Wordsworth saying about daffodils, that these flowers are transitory. Our life is transitory, isn't it? So many assets in accounting, especially these supplies, prepaid insurance, these current assets, these are very transitory. The assets for what? They're only assets for 1 year. That means every month, part of the asset is becoming an expense. Even the solid assets, except for land, most other assets are subject to decay, subject to depreciation or amortization, subject to reversal, subject to expense. So always remember that in the long run, there is no fixed cost. And in accounting, learn it, in the long run, there is no asset. All assets are expenses. All assets one day will become an expense. Therefore, assets would need to be shaved off as we go, as new and new periods expire. All right. So I hope that we were able to make a point as to the need to make adjustments. Remember, the need originates from the matching principle. The need originates from appropriate and preparation of relevant financial statements, relevant financial information, because we owe that to our users. We have an obligation to produce and provide information that is relevant and reliable, that has representational faithfulness. Nowadays, we call it representational faithfulness. One of the qualities of accounting, that information has to be relevant and representationally faithful. It used to be called reliable. So to make it more I think more user-friendly, we can use the terms reliable and relevant. So an information that is outdated is not relevant. I can't use it. Okay. For example, my laptop, I bought it for $900, but it's not worth $900 anymore. It has been depreciating, and it's 2 years old, so it should now be reported at a lower book value. And the building, the same happens with building, especially for those assets that are that gradually, on a periodic basis, that diminish on a periodic basis. I mean, you could argue that for buildings or equipment that they don't diminish. For many houses, the value actually goes up. So that's a different debate. But the fact that for, say, prepaid insurance, it is diminishing as every day goes by. Prepaid rent, it's not going to be prepaid as I keep living there, as I keep using it. All right? Supplies, for example, as I keep using those napkins, as I keep using those detergents, they're not going to be assets anymore. They're expenses. So those expenses must be recognized to claim responsible accounting, to have conservative accounting, to have proper accounting. So adjustments are an essential element of the accounting process. So we call it an essential step in the accounting cycle. Once we carry out that step, we now, as soon as you enter those journal entries, you know that as soon as you pass a journal, it immediately affects the corresponding ledgers. So the ledger balances will now change, and automatically the old trial balance will convert into a new trial balance. It will still be a trial balance, but it will look new. It will look different. It will have different numbers, and hopefully it will have more useful and more complete numbers. Once you have those complete numbers, you now have an adjusted trial balance. You are ready to prepare financial statements. So next, one of the next videos, I hope to talk about preparation of those financial statements. But today, this is the end of our accounting adjusting process. Thank you so much for your attention. I hope you like it. Bye-bye.